Now let's bring in George Tillis, a senior markets correspondent here. We're talking PayPal, George. This one has been suffering, as I mentioned before we left to break. This thing's hitting 6-year lows. I mean, it doesn't seem like there's any reprieve for this name.
No, not at least in the near term. I don't think so. I mean, if you look at the stock, it's down about 43% over the last 5 years, and it's been drifting lower since its peak back in 2021, which is over $300. And it's been unfortunate for PayPal investors, but I can see what's going on with it. I'll explain in a second. But you got to think about what they do. They're the largest electronic payments provider globally. Some estimates have 40% market share for PayPal, but from business to consumer standpoint, they're essentially the #1 leader in payment solutions. But they also have consumer to consumer payments through Venmo, international transfers. They've got their division called Zoom, but also e-commerce solutions, which includes things like mobile web payments for payment processing and even invoice management through their Braintree division. So the company's made a lot of acquisitions in the past few years, and some would say that hasn't manifested into good profitability profile for the business. And I can see that if you even compare the sales for PayPal compared to 2018, their sales are higher to $28 billion versus about $15 billion in 2018, which is nearly double. But if you look at the share price, it hasn't really reflected that. So I think what we're seeing here is just a classic case of, yeah, the sales have been growing, but the sales growth has been decelerating. And if you look at the earnings growth for PayPal, the estimates for earnings are only about 6%, whereas sales about 8%. But if you go back to their 5-year average for earnings growth, it was in the mid-teens, around 16%. So even though sales have been growing, and even though sales growth is about half of where it was, let's say about 5 years ago, earnings growth is only 1/4 of where it was 5 years ago. So what I see here is a company that from a financial standpoint is not cheap from a value standpoint, nor is it a growth stock anymore. So I think this is one of the reasons why, or just a couple of reasons why, it's fallen out of favor by investors.
George, down 81% off its highs. This stock now trades at the cheapest price to sales multiple in its history. It's not like it's an outdated or horse and buggy business model. It's digital payments, George. It's Venmo. It's all the things that the digital economy seems to be drifting towards. What's the problem? If George Tillis was the CEO of PayPal, what would he do to turn this stock around?
Well, I mean, I can tell you this. When you look at gross margins for a digital business like this, it's actually very low. And so with that said, I think there's something going on internally they can do to reduce expenses. I think also divestitures in terms of some of the businesses they purchased over the last few years need to go away. They sold off their European buy now, pay later business to KKR. They earned about $1.8 billion. But with the proceeds, they're buying back shares. I mean, I looked at their share count. The share count is down compared to 5 years ago. And ideally speaking, it hasn't supported the stock. And I think what they've got is a problem on how to deploy the capital that they're generating. They've got a lot of total payment volume. I mean, it's over $1 trillion in total payment volume globally. I think the challenge is really the economics of the business itself, whether it's divestitures that are needed. I think they need to improve their scalability to capitalize on the fact that they're a very popular and very ubiquitous brand from a digital payments processing standpoint.
All right, great breakdown here of PayPal. 431 million active accounts, and this stock just cannot right the ship here at this point. All right, thanks to George Tillis for breaking that down for us.